This video will discuss Business Financial Essentials Chapter 1, Introduction to Financial Management. Learning objectives include define what is meant by finance and describe some of its primary areas, define and compare or contrast sole proprietorships, partnerships, and corporations, identify key advantages and disadvantages of the corporate form of ownership, define and identify key characteristics of stocks and bonds, define the primary goal of financial management, identify the three elements that impact achieving that goal, explain and apply the concept of risk aversion, explain how social responsibility and ethical behavior is consistent with maximizing shareholder wealth, and define the concept of agency relationships and explain how they influence the goal of maximizing shareholder wealth. There are many different definitions of finance, but for the purposes of this course, we're going to define it as follows. Finance refers to the process of allocating capital in order to optimize the risk-adjusted expected return on that capital. This can apply to corporate finance, where firms are allocating capital across various operations within the firm, making decisions which long-term projects they should undertake, developing dividend policy, planning how to raise funding, etc. It can also apply to banking, where financial institutions evaluate who to lend money to and how much to charge in interest rates. It can apply to personal finance, where individuals develop budgets to manage their spending and make investments to meet future goals, such as retirement. There are several primary areas of finance. These include commercial banks, credit unions, insurance companies, and countless other financial institutions are an important part of the financial landscape. These institutions deal with financial concerns such as risk management, time value money, financial intermediation, providing short-term and long-term financing to individuals and businesses, payment processing, and many other activities critical to the financial environment. Banks and other similar financial institutions are among the primary employers in the field of finance. While we will deal with some of the issues that are of concern to these financial institutions, time value money, risk return analysis, types of financial instruments, etc., this class will not be primarily focused on banking-related issues. Now turning to investments. One of the common images associated with finance is the stock market. The field of investments deals with stocks, bonds, options, mutual funds, futures, and many other financial instruments. Some of the key considerations in the field of investments include valuation analysis, risk return analysis, diversification, and fit. By fit, we mean that what may be a good investment for one individual may be a poor investment for someone else due to each person's unique set of investment objectives. There are many career paths related to investments, including stock analyst, fixed income analyst, portfolio manager, trader, etc. These careers tend to be very competitive, demanding, and offer the potential for high income. Personal finance deals with a variety of financial decisions made on the personal level. This includes areas such as retirement planning, insurance, and personal budgeting, e.g., can I afford a new house or new car, and any other financial decision that a person makes. While personal finance is not the primary topic of this course, it is an important issue for everyone and overlaps with many of the main themes, such as time value money, diversification, and valuation analysis, that we will discuss. Due to its importance and overlap with our primary focus, we will spend a fair amount of time discussing personal finance issues. The most common career path associated with personal finance is the financial advisor planner. A financial advisor works with individuals to help them achieve their personal financial goals. Financial planning is an expanding field and is consistently rated very high in job ranking evaluations due to its combination of potential income and job satisfaction. Corporate finance, business finance, and managerial finance are often used interchangeably and refer to the field of finance dealing with financial decision-making from a business perspective. Primary topics for corporate finance deal with raising capital, such as issuing stocks, bonds, or other forms of financing, paying dividends, maximizing value for shareholders, evaluating potential long-term investments that the firm will undertake, for example, building a new warehouse, and managing the firm's cash flows. If you have a strong background in accounting, these are often among the top candidates for jobs in the field of corporate finance. This book will touch on several of these topics. If you're interested, you may find more information about potential finance-related careers at the Careers in Finance website. But our primary focus will be on corporate finance. In order to do this, we must start by defining the concept of the corporation or firm. There are three basic forms of business organizations: sole proprietorships, partnerships, and corporations. We will focus on the corporation, but we also will introduce all three forms simply to give the basic framework of each. Sole proprietorship is a business organization where the owner is a single person and is solely responsible for control of the business. While the owner can hire employees and managers, it is ultimately the owner that is in charge. One important characteristic of a sole proprietorship is that, from a legal and tax perspective, there is no real distinction between the owner and the business. The owner is liable, legally and financially, for the actions and liabilities of the business. The income is only taxed once, as opposed to being taxed at both the business and personal level. A partnership is structured much like a sole proprietorship, except now there are multiple owners. There is no distinction between the owners and the business, as they are all liable, legally and financially, for the actions and liabilities of the business. Like in a sole proprietorship, the income is only taxed once. In practice, there are different types of partnerships: general, limited, limited liability. The general partnership is what's described above. A limited partnership involves at least one general partner to manage the company and take on the risk. Limited partners are passive investors. Last, a limited liability partnership allows partners to limit their legal, limited to each partner's behavior, and financial liability, limited to the assets of the business, while still maintaining the tax structure of a general partnership. Specifics of partnership law vary by country and by state. A corporation is a firm owned by many individuals or stockholders who in most cases have little input in operating the firm. A fundamental component of the corporate form of ownership is the separation of ownership from the process of managing the firm, otherwise known as control. The owners or stockholders elect a board of directors who are responsible for hiring management and overseeing the direction of the firm's operations. Corporations account for the bulk of business activity in the U.S. because most large firms are organized as corporations. Specifically, while approximately 18% of business tax returns were filed by corporations, they accounted for about 82% of total revenues by businesses and 63% of taxable income, according to IRS SOI tax stats in 2012. Because most large firms are organized as corporations, accounting for the bulk of business activity in corporations are more complex. We will focus on the corporation in this text. Due to the separation between business and the owner, stockholders are typically not liable for anything beyond their initial investment. Buying a share of stock and becoming an owner in a corporation, an individual can lose his entire initial investment if the company goes bankrupt, but nothing beyond that. Remember that this is not the case for sole proprietorships or general partnerships. Easier access to capital. Corporations have access to the capital markets by issuing shares of stock or issuing bonds. This makes it easier to raise large sums of money for expansion or a multi-year, profitless startup that is anticipated to generate significant profits after the startup stage. Sole proprietorships and partnerships find it much more difficult to raise significant amounts of capital. Snap Inc., or Snapchat, is an example of a limited liability corporation that recently became a publicly traded corporation by an initial public offering, or an IPO. The Snap IPO was offered March of 2017 with the original price of $17 per share. Upon opening, demand for the popular IPO pushed the price to $24 per share, a 44% increase, giving the company a $32 billion valuation. Despite several red flags, investors continued to purchase Snap stock. The company had yet to see an operating profit, losing $500 million in 2016 and $372 million in 2015, and its net worth for 2016 was a mere $1.5 billion. Over the following few months, the stock price gradually fell, trading significantly below its original offering price of $17 per share. Corporations allow individuals to own multiple businesses without having expertise in all or even any of these businesses. This allows an investor or owner to reduce her risk and take advantage of opportunities that would not be accessible without corporations. The chance of an investor owning multiple businesses in different industries as a sole proprietorship is minute due to time, capital, and expertise issues. Alternatively, it is easy for an individual to invest $5,000 into a mutual fund and become a part owner of hundreds or thousands of different businesses. Disadvantages of corporations include higher startup costs and higher levels of regulation. Because there is a separation between the owners and the business, there are higher regulatory costs associated with keeping owners informed about business operations. Publicly traded corporations must follow the Securities and Exchange Commission or SEC guidelines pertaining to registration and reporting, such as audited annual and quarterly reports that are costly. According to a report by Protiviti in 2016, the average firm spent between 1.113 and 1.442 million in internal compliance costs to comply with Sarbanes-Oxley or SOX regulations. This is just one of the regulatory costs associated with being a corporation. These expenses lower the profitability of the company, but may be necessary to protect shareholders. Because the owners in the business are treated as two separate entities under the corporate form of ownership, both are taxed. The business must pay corporate income taxes on any income it makes. When investors make money through dividends, or a distribution of corporate profits to owners, or through capital gains, an increase in the value of a share of stock, these are taxable. The current tax code taxes dividend income and long-term capital gains at a lower rate than ordinary income, which substantially reduces, but does not eliminate, the impact of double taxation. Given the volatile nature of tax codes, the impact of double taxation is likely to fluctuate over time. Agency costs will be discussed in more detail later, but essentially it's the idea that the owners of the company are not handling decision making. Therefore, there's potential for the decision makers to run the firm more in their own self-interest rather than in the best interest of the owners or shareholders. Note that our focus will be on the corporation, meaning the same ideas apply to other types of business organizations, such as sole proprietorships, partnerships, limited or general, S corporations, and limited liability companies, as well as personal financial decisions. The two primary sources of financing for corporations are stocks and bonds. These are essential financial instruments that we'll discuss in depth. The basic characteristics of these securities, where a security is just a generic name for a financial instrument. Stocks are a form of ownership or equity in a corporation. When you own a share of stock, you're actually a part owner of the corporation. Large corporations have several million or billion shares outstanding, so when an individual owns 100 shares, they own a very small fraction of the firm. ExxonMobil had 4.24 billion shares outstanding in May 2017. Amazon had 478 million, and Winnebago had 31.6 million at that time. As an owner, you're entitled to a piece of the company's profits on a prorated basis equivalent to the percentage of ownership. The firm can choose to distribute those profits back to shareholders in the form of dividends or reinvest them back into the company. Sometimes firms will engage in buying back shares of their own stock as a substitute or in addition to dividends as a way to return profits to shareholders. We need to be careful because there are other reasons why firms may engage in buybacks, but the majority of S&P 500 firms engaged in stock buybacks in 2016. When firms reinvest the profits back to the company instead of paying them out as dividends, the value of the firm should increase, assuming the profits are reinvested wisely, which will result in capital gains. Your return from owning stock can come from two sources, dividends and/or capital gains. Because the dividends and capital gains essentially represent your portion of the company's profit, they can fluctuate dramatically over time. Dividends represent the portion of the profit that is currently being paid out, while capital gains are dependent on investors' expectations of future profits. Some companies expand rapidly and are extremely successful, leading to high returns. Others struggle or even go bankrupt and lead to negative returns. As such, the returns associated with stock ownership are highly volatile and risky. Because investors are risk averse, stocks must generate higher expected returns than safer investments like bonds in order to attract investor interest. This does not mean that any individual stock or stocks in general will generate a higher return, only that its expected return will be higher. A final issue associated with stocks is that there is no maturity date to stock ownership. When you buy a stock, you own it until you decide to sell or the company goes bankrupt. Theoretically, the timeline for this type of security is potentially infinite. However, in practice, we find that publicly traded companies have a much more finite lifespan of approximately 15 years. In the article, Where Do Firms Go When They Die?, the author discusses this relatively short lifespan. This refers to the stock itself, not the investor's holding period, which may be as short as a few seconds or as long as several decades. Bonds are a form of debt. When you buy a bond, you are lending the issuer money. In addition to corporations, governments, federal, state, local, and national, also are large issuers of bonds. The loan is structured so that the bondholder typically receives a fixed interest payment, referred to as a coupon payment, every 6 months until the bond matures. At maturity, the bondholder receives the last coupon payment and the par or maturity value. Unlike dividends, which firms can increase, decrease, or discontinue at their discretion, promised coupon payments on bonds must be made to bondholders on time or the company can be forced into bankruptcy. Bondholders are first in the priority of payments and must receive their promised payments before the stockholders get anything. Due to this priority of claims, the fixed cash flow stream, coupon payments and maturity payment, and the fixed time horizon, bonds are considered lower risk than stocks. Given this lower risk, bonds will typically have lower expected returns. Note, there can be exceptions where the bond of a firm that is exhibiting financial stress may be riskier and have a higher expected return than the stock of a large stable company. A lower expected return does not mean a lower return for any particular bond or for bonds in general in a particular year. In any given year, bonds can earn higher returns than stocks, but typically over longer periods of time, stocks usually earn higher returns than bonds. You can compare historical returns for the S&P 500, 3-month Treasury bills, and 10-year Treasury bonds on a data page by Oswald de Moderon. Since 1928, stocks as measured by the S&P 500 have had annual returns that are about double that of 10-year Treasury bonds issued by the U.S. federal government. Alternatively, the volatility of annual returns over the same time period has been almost 3 times as high for the S&P 500. The higher return of stocks significantly understates the benefit over this time period if one is not aware of the power of compounding. Specifically, $100 invested in stocks at the start of 1928 grew to $328,584 by the end of 2016. The same $100 invested in 10-year Treasury bonds over the same time grew to $7,111. While the average return was about twice as high for stocks, the total wealth accumulation was over 45 times as high during this time frame. The goal of the financial manager is to maximize shareholder wealth, sometimes referred to as maximizing firm value, since increasing the firm value increases shareholder wealth. 3 factors impact firm value listed below. Note that we use cash flows, not earnings or net income. There are many similarities between earnings and cash flows, but they're not the same. We'll always focus on cash flows instead of earnings. Cash flows are considered more important than earnings for 3 reasons. The accrual-based approach of net income accounting can distort the timing of when cash is received or spent. The time value of money recognizes that money spent today is more costly than the same money spread out over years. Something like depreciation may understate the financial cost of owning assets. Generally accepted accounting principles, or GAAP, or International Accounting Standards, IAS, allow corporations some flexibility in how they account for revenues and expenses. Firms that choose to aggressively apply GAAP or IAS may mislead shareholders by reporting artificially high earnings. Cash flows are harder to manipulate than net income or earnings. Cash is the lifeblood of a business. Ultimately, it doesn't matter if the firm is profitable on an earnings basis if it isn't generating enough cash to pay its employees, suppliers, creditors, etc. The firm needs to generate positive cash flows in order to maintain its operations. The word expected is a critical component of the 3 factors. While what has happened in the past is not irrelevant, the relevance is based on how it might impact future cash flows. Investors base their valuation decisions on the future of the firm. When analyzing stock price changes to information, it is always essential to consider what the new information is relative to what expectations were. An analogy would be to compare 2 students in junior high. The first student normally gets A's in her classes, while the second student normally gets C's. Both come home with several B's on their report card. While both receive the same grades, one will likely result in disappointment, while the other will likely be celebrated. The difference is not the performance, but the performance relative to expectations. With stocks, new information causes investors to revise their expectations for future cash flows to the firm. If the new information is better than previously expected, investors revise cash flow forecasts upward and the stock price goes up. If the new information is worse than previously expected, investors revise cash flow forecasts downward and the stock price goes down. The three key elements, magnitude, timeliness, and riskiness, are not individual goals. Everything else being equal, higher cash flows are preferred to lower cash flows, less risk is preferred to more risk, and earlier receipt, later payment of cash flows is preferred to later receipt or earlier payment. However, things are rarely equal. Increasing the magnitude of cash flows usually means taking on higher risks. Less risk usually means lower expected cash flows. Thus, we need to keep the primary goal to maximize firm value in mind and realize that the interaction of risk, magnitude, and timeliness are more important than any one separately. The concept of maximizing firm value is not specific to finance. The purpose of marketing, internal accounting, personnel decisions, production, etc., is to maximize firm value. When an individual is hired in any field, the rationale for that decision is that the company plans for that person to directly or indirectly increase its value. If you're an employee of a corporation and are not adding value, what reason do the shareholders have to pay your salary? While the concept of risk aversion has been addressed briefly in the previous discussion of stocks and bonds, this topic is worth exploring in more detail as its critical assumption underlying the analysis that will be covered as we unfold. Risk aversion refers to the idea that investors don't like risk. All else equal, two investments have the same expected return, investors will choose the one with the least risk. However, risk aversion does not mean investors avoid risk at all costs, only that they need to be paid to take on extra risk. If investors were risk minimizers instead of merely risk averse, the stock market would not exist, as investors would not take the risk associated with investing in stocks, regardless of the higher expected return. Investors will take on extra risk, assuming they receive adequate compensation for doing so. Does adequate seem like a vague word? It should, it's intentionally vague. The reason for this is because people have different levels of risk aversion depending on their personality, age, income, and other factors. Some people are highly risk averse, needing significantly higher expected return to take on a little more risk, while others are not or only mildly risk averse, needing only slightly higher expected return to take on significantly more risk. Social responsibility and ethics are not inconsistent with maximizing firm value. While there is a cost to engaging in ethical and social responsible behavior, there are often benefits in goodwill and public relations that may more than offset these costs. There's substantial evidence that engaging in social responsibility and ethics is highly consistent with maximizing shareholder wealth. A study by Margolis et al. In 2009 reviewed 251 other studies examining social responsibility and firm performance. They find a consistent pattern that social responsibility is correlated with firm performance. The overall mean correlation is 0.13, indicating a small positive relationship. 28% of the studies reveal a statistically significant positive relationship, 59% reveal none, 2% suggest a statistically negative relationship, with about 10% not reporting a sample size to make statistical significance impossible to measure. This implies that the overwhelming evidence suggests that corporations behaving in a manner consistent with social responsibility and ethical behavior are likely to either benefit financially or not experience any noticeable financial downside to doing so. In other words, companies that do the right thing will either generate additional financial rewards to shareholders or, at the worst, not cost their shareholders. However, we must remember that while social responsibility is consistent with our primary goal, maximizing shareholder wealth, it is not the primary goal in and of itself. While it seems wrong to say that a corporation can spend too much money on trying to improve the welfare of society, keep in mind that the owners of the corporation are the stockholders. When a corporation writes a large check to a charitable organization, essentially the managers of the corporation are deciding where and how to spend the stockholders' money. It would be fairer to let those stockholders decide how to allocate their money. For an example of some firms that rate high in social responsibility and ethics, take a look at Business Ethics List of 100 Best Corporate Citizens. One critical aspect to maximizing firm value is recognizing the business is global, not national. The census for May 2017 shows that there were 325 million people in the U.S. and 7.4 billion people on the planet. Marketing solely to the U.S. excludes over 95% of potential customers. While not every customer has equal purchasing power, it makes no sense to exclude 95% of your potential customers. From an economic standpoint, the majority of economic activity is also outside the U.S. According to World Bank GDP ranking, 2015, the U.S. had GDP of 18 trillion, while global GDP was 74.2 trillion. 76% of economic activity occurs outside the U.S. In addition to our customers, many of our competitors and or suppliers may be based internationally. If we ignore the global aspects of business, we are not maximizing firm value. If we think of international business from the three aspects of maximizing shareholder wealth, the magnitude, timeliness, and riskiness of the expected cash flows, we can see that international business is likely to have a significant positive impact on the magnitude of expected cash flows. The timeliness is likely to be slightly slower, but not nearly as significant. The riskiness can go either way. On one hand, international operations introduce new risk factors, such as political, cultural, exchange rate. On the other hand, sometimes international operations can help diversify away some of our risk. How do we know that international business is an essential element to maximizing shareholder wealth? According to the S&P Indices report, in most years, the S&P 500 firms report a breakdown of foreign revenues between 40 to 50% of the revenues from foreign countries. Since they are among the largest firms in terms of market values, clearly foreign revenues are a key component of firm value maximization. An agency relationship exists anytime one or more people, the principals, hire another person, the agent, to perform the service and then delegates decision-making authority to that person. The central issue with agency relationships is potential conflict of interest between the principal and the agent or between two or more groups of principals. Agency problems can cause difficulty in maximizing firm value. The major agency conflict we'll focus on is between managers, stockholders, or owners. Stockholders hire managers under the goal of maximizing firm value, as doing so will maximize the wealth of shareholders. However, the manager may operate under the goal of maximizing its happiness instead of firm value. This may take the shape of overspending on perks like office decorations, company jets, etc., or on limiting risk in order to protect job security, even at the expense of favorable risk-adjusted return opportunities. There are many ways to try to control for agency costs, including the threat of firing. While most people understand the threat of being fired, this is not an overwhelming threat to most top managers, although it is more credible for other employees of the firm. Many chief executive officers or CEOs get rich compensation packages or golden parachutes, even if they are forced out of their position. There are some instances where the board of directors, the people responsible for hiring and paying the CEO, may be friendly to the CEO. In many cases, the CEO is also chairperson of the board of directors. The article, The Top 20 CEOs with Even Bigger Golden Parachutes Than Marissa Mayer's, lists the CEOs who hold the largest golden parachutes in the S&P 500. Threat of takeover. If a firm is purchased by another firm, the acquiring firm may replace upper management. One reason for a takeover is that the management team is not maximizing firm value. If others feel that they could run the firm in such a way as to make it more valuable, they may buy the firm with the intention of bringing out this additional value. However, takeovers are not cheap. Most acquiring firms pay premiums of 20 to 50% to complete a takeover. For example, if the stock price before the takeover is $50, the takeover offer may be $70 per share. This leaves a lot of room for mismanagement. If a firm's assets are worth $60 per share under optimal conditions, but under current management are only valued at $50, management is not maximizing firm value. However, it may not be bad enough to justify a takeover. Many firms use defenses like poison pills that make takeovers hard to execute. For example, there may be a clause in the debt agreements that all debt becomes due in the event of a takeover. Influence of large shareholders. This is a relatively new form of corporate governance that is gaining prominence. Activist investors may pressure management to run a more efficient operation. If a shareholder with a large stake in the firm creates enough pressure on management and the board of directors, changes to the firm's strategy and/or operations may occur. Compensation packages. The best way to make managers interested in maximizing value is to pay them based on their stock performance. This is often accomplished through payment with stock options, the right to purchase shares at a fixed price even if the stock goes higher. Also, many CEOs own significant amounts of stock in the company they work for. Caution must be exercised that compensation is based on maximizing value and not other factors. For example, compensation based on the size of the company's assets may create incentives to make investments that increase assets without adding value. Also, compensation based on meeting sales targets may get met by selling items for a loss, which reduces firm value. Finally, stock options may be the most popular way of trying to align the interests of shareholders and managers, but they also have some serious flaws. Specifically, The way many option packages are granted, they reward short-term fluctuation in the price of stock more than long-term value creation. There have also been issues related to the timing of option compensation that has acted more as a wealth transfer to executives rather than an incentive. Compensation packages must be carefully designed to align the interests of management with the objective of creating shareholder wealth in order to minimize agency conflicts. Another agency conflict arises between the two principals, the stockholders and bondholders. Because of the difference in the way stockholders and bondholders are compensated, their attitudes toward a worthwhile investment may be different. This can lead to conflicts between which projects to undertake. Generally, bondholders prefer low-risk investments as their potential return is limited, and stockholders prefer higher-risk investments, assuming the higher risk is compensated by higher return. The better we can control these agency problems, the better our chances of maximizing firm value. The term corporate governance is used to describe the policies that firms have in place to better align agency issues. Two studies that address this are Gompers et al. In 2003 and Kunat et al. In 2010. These studies provide evidence that improving corporate governance results in higher shareholder wealth. Finance deals with the allocation of capital in order to optimize the risk-adjusted return earned on that capital. While the concept applies to both personal and business-oriented decisions, the focus will be first on corporations and secondarily on personal issues. The corporation is a form of business organization that separates out management from ownership and accounts for the bulk of business activity within the U.S. The primary objective of financial management within the corporation is to maximize shareholder wealth. This is accomplished by focusing on the magnitude, riskiness, and timeliness of expected cash flows. Three larger issues that influence the scope are social responsibility and ethics, international business operations, and agency relationships. A corporation is a type of business organization that separates the management and ownership of the business. Ownership of the corporation is based on owning stock or equity in the firm. Owners have a right to the income that the business generates, a claim against the assets of the business, secondary to creditors, and then hire, for a board of directors, a management team to operate the business and make strategic decisions. Ford is an example. If you buy 100 shares of Ford, you're a part owner of the firm, but you're not involved in the process of running a business. Because of the separation between ownership and management, there are some unique characteristics of a corporation. Limited liability. Owners' losses are limited to their initial investment. If you invest $1,000 in Ford stock, that is the most you can lose. Even if the firm goes bankrupt and cannot pay all of its bills, your investment may become worthless, but you will not owe additional money. Double taxation. Because the owners and the business are separated legally, they are separated in the eyes of tax code as well. This means the business is taxed on its income, corporate income tax, and then owners are taxed on any profits they earn on their investments into the corporation, dividends and capital gains taxes. There are several other forms of business organization, sole proprietorships, partnerships, and many other technical legal issues related to business organization, but these are beyond the scope. We'll focus on the basic corporate form of organization for our purposes. The concepts of limited liability and double taxation were explained in the previous slide. In addition to understanding these concepts, it's important to understand their impact on investors in a corporation. Limited liability is critical due to the separation of ownership and decision making. Not many investors would be willing to supply capital to the firm if they were not part of the decision making process and could be held liable for all the firm's actions. Consider a situation where you invest in a restaurant chain by buying 100 shares of stock for $20. You invest $2,000. Now imagine this restaurant chain, without your knowledge or approval, used non-inspected meat that caused several deaths. With unlimited liability, it would be conceivable that you, as a passive investor, could lose everything before bankruptcy for actions that you had no influence on. If this were the legal environment, very few people would be willing to purchase shares of stocks, or becoming owners, in corporations. This would greatly restrict the amount of capital and make it hard for firms to raise the necessary money to build plants, develop new products, or hire employees. Limited liability is essential to create an environment where investors are willing to the necessary capital to allow corporations to operate. Double taxation also impacts the ability of corporations to attract capital, although negatively. When investors purchase stocks and invest in ownership of a corporation, They are doing so in order to earn a profit. In investing, this profit is often referred to as rate of return. The rate of return is what compensates the investor for both undertaking risk and for tying up the investor's money for a period of time. The investor is concerned with the ROR, rate of return, after taxes, as that is what will be left over for the investor to spend. Double taxation lowers the after-tax rate of return and means investors must demand a higher before-tax rate of return. This makes it more expensive for firms to raise money and also means that some projects may no longer be worth pursuing. The more that firms must pay to raise money, referred to as the cost of capital, the less productive the economy will be. This is why things like capital gains and dividend tax cuts are often thought to be something that can stimulate the economy. Because of the separation between ownership and management in the corporate form of ownership, it is critical that the passive owners get the necessary information regarding the firm's financial performance in order to evaluate their investment. Without accurate and reliable information, the owners cannot make good decisions about which corporations to invest in. Also, unethical managers could use misinformation to take advantage of investors. If there were not audited financial statements, managers could exaggerate their performance in order to get more pay and other perks, as shareholders would think that management was more productive than it actually was. This scenario occasionally occurs even with audited financial statements, as some managers are able to commit fraud and trick the auditors. In the late 1990, early 2000 time period, there were several instances of this occurring. These financial scandals severely eroded investor confidence and were one of the factors in stock prices plunging during 2001 through 2003. As a response, a series of enhanced financial reporting regulations called Sarbanes-Oxley, or SOX, were passed to improve the accuracy of information. While this has resulted in much better information for owners to use in evaluating investment decisions and which corporations to invest in, it is also quite costly for the corporations. As these higher costs lower profitability, ultimately, it is the stockholders or owners themselves that are paying for this better information. Is it worthwhile? There is much debate about that. It is clear that too little information is problematic, but spending too much on information can also be bad. If a firm loses too much of their profits in preparing the information, there may not be enough left over to make the investment worthwhile. Finding the balance is a challenging proposition. The two primary instruments corporations issue to raise money are stocks and bonds. Stocks are an ownership interest in the firm, and bonds are a structured loan made to the firm. There are many other forms of debt financing other than bonds, like bank loans, leases, accounts payable, etc. Bonds are a primary source of long-term debt financing for many corporations. When comparing stocks and bonds, it's important to think of the primary characteristics of each. Stocks pay a variable cash flow stream called dividends. Dividends can increase or decrease over time, and firms are not required to pay them. Many stocks currently pay no dividends. In addition to profiting from dividends, stockholders may also see a capital gain when the value of their stock goes up, or a capital loss if the value of the stock goes down. The change in the value of the stock will be related to the prospects of the business. In general, the more successful the business, the greater the value of the stock, since a share of stock represents a small ownership in the business. Bonds make two primary payments to investors. First is the coupon payment. This is a fixed annual interest payment to bondholders. Unlike dividends, coupon payments do not increase or decrease over time, and the firm must make promised payments, or it can be forced into bankruptcy. The second form of cash flow paid to investors is the par value. At the end of the bond's life, the firm will pay the bondholders a par value, sometimes called maturity value, to retire the bond. The coupon payment represents the interest, and the par value represents the return of the borrowed money. The value of a bond can also fluctuate based on changes in market rates of interest. Stocks have an infinite time horizon. The ownership interest exists as long as the firm does. If the firm goes bankrupt or is purchased, taken over by another firm, then the stock may cease to exist. However, the stock never matures. Your ownership interest generated by buying 100 shares of PepsiCo until you sell it to someone else, or PepsiCo ceases to exist as a public company. Bonds have a finite time horizon. A bond's maturity, like 5 years, is set at the time the bond is issued, and once that maturity is reached, the bondholder is paid the par value and no longer receive coupon interest payments. Both stocks and bonds can be sold at any time in the financial markets. So purchasing a stock doesn't commit you to holding it forever, and purchasing a bond does not commit you to holding it until maturity. Stockholders are not involved in running the firm or making strategic decisions for the firm. However, they have limited control through their election of the board of directors. The board of directors is in turn responsible for hiring, firing, and compensating management. For practical purposes, most stockholders have very little control of the firm. Bondholders have no control of the firm, as they are creditors rather than owners. However, bondholders will usually include provisions that protect their interest to some extent in the legal agreement created when the bonds were issued. Stocks are riskier from the investor's perspective. Dividends are variable. Investors don't know what they will receive in terms of the cash flows. Also, stockholders have a lower priority of claims than do bondholders. Bondholders must be paid in full before stockholders get anything. Bonds are less risky from the investor's perspective. The cash flows, the coupon payments and par value, are known in advance, and bondholders have a higher priority of claim than stockholders, making it more likely they will receive most of their money back if things go wrong. Note that long-term bonds are riskier than short-term bonds, and some types of bonds are riskier than others based on who issued them. Risk and return are closely related. Since stocks are riskier, they typically offer investors higher rate of returns than do bonds. The goal of financial management is to maximize shareholder wealth, the value of the firm. Management accomplishes this goal by focusing on the magnitude of expected cash flows, the timeliness of expected cash flows, and the riskiness of expected cash flows. There are a few important observations to remember with this. Generally, shareholder wealth is increased when the stock price increases, so that maximizing shareholder wealth is the same thing as maximizing firm value. The value of the firm should be based on long-term value creation, not short-term stock price manipulation. Assuming the number of shares is held constant, increases in the stock price represents progress towards value maximization. Expectations mean that investors must be forward-looking. The impact of what will happen over the next year is far more important than what has happened over the last year. Also, financial results need to be compared to what was expected to happen in order to be understood. The three elements of value maximization need to be considered as a whole, not independently. Our goal is not to minimize risk. Doing so would mean never starting any new projects, but to maximize the value of the firm, shareholder wealth. It is not to maximize cash flows, as that may entail too much risk, but to maximize firm value, or shareholder wealth. It is not to get money into the firm as soon as possible, as many valuable projects may require several years to generate value, but to maximize firm value, or shareholder wealth. Only when we consider all three factors as a whole can we achieve our primary goal. There are several reasons to focus on cash flows over earnings per share or net income. First, accounting earnings distort timeliness issues. In finance, it is critical to recognize when cash flows are received or paid out, as the value of those cash flows is dependent on when we receive them. It is better to get a dollar today than the same dollar 9 months from now. Second, accounting earnings are easily distorted. There are several different ways to recognize various revenues and expenses, LIFO versus FIFO, depreciation, etc. Changing the accounting method can change net income, but it doesn't affect value. Focusing on cash flows reduces this problem. Third, it's possible to have to generate accounting profits and not have enough money to pay the bills. Firms need healthy cash flows in order to stay in business. The vast majority of the time, earnings per share and cash flows will tell us the same thing. When they differ, we want to focus on the cash flows. Risk aversion means that everything else equal, investors prefer less risk. In order to get people to invest in riskier investments, they need to anticipate higher rates of returns. A few important points on risk aversion. It doesn't mean the same thing as risk minimization. A risk minimizer will always choose the lowest risk alternative. A risk averse, not adverse, individual may choose the higher risk alternative if he or she is receiving enough compensation to offset the higher risk. The degree of risk aversion is very personal and varies based on a number of factors like age, wealth, income, personality. One individual may be willing to take a higher risk for a very small increase in anticipated return, while another individual may require a significantly higher anticipated return to undertake the same risk. Risk aversion is a valid assumption for most people despite a few common exceptions. While many people love to gamble, like Las Vegas and lotteries, which typically has negative expected returns, this can be explained by two factors. First, most people consider this an entertainment expense rather than an investment. Second, most people gamble with small stakes. When evaluating investment decisions, most people exhibit risk-averse behavior. Half the time you flip the coin, you will get heads and get $2. The other half the time, you'll get tails and get $0. This means on average, you'll get a dollar. Since you're paying a dollar for the opportunity, your expected value is zero. On average, you won't make anything or lose anything on the flip. However, you're undertaking risk since you flip the coin, get tails, and lose a dollar. A risk-averse person will not want to undertake risk without a payoff, so should not take the coin toss. However, if you're able to buy the coin flip for only 90 cents, you will be making an average of 10 cents every time you flip the coin. Since you're earning a profit, a risk-averse person might choose to undertake the coin flip. On the other hand, not all risk-averse people will. Some people will find the 10-cent profit high enough to take the risk, while others, that are more risk-averse, will think 10 cents is not enough to take the risk. The amount of profit you need to earn in order to justify taking the risk is dependent on you as an individual. Different people will have different degrees of risk aversion. Globalization impacts firm value through both the magnitude of expected cash flows and the riskiness of expected cash flows. Globalization opens up more markets, which can increase expected cash flows. This is because approximately only 5% of the global population, 25% of the global GDP, belong to the U.S. That implies that 95% of our potential market in terms of customers and 75% of our potential market in terms of dollars lies outside the U.S. Globalization also exposes firms to more risk factors like currency, political, and cultural risks. In most cases, the benefits of the higher potential expected cash flows more than offsets the negative of the increased risk. Social responsibility is being proactively concerned with the society's welfare. Ethics is the center of conduct or moral behavior. Social responsibility and ethics are factors that help us achieve our goal of maximizing firm value over the long run. Ethics adds value through a concept known as reputational capital. When employees, customers, suppliers, etc., feel that our firm is ethical and trustworthy, this will help us in many ways. For example, a firm that has a reputation of treating its employees in a fair and respectful way will likely have an easier time recruiting and helping high quality employees. Firms that treat suppliers in an unethical manner may find those suppliers unwilling to do business with them in the future. Social responsibility can help add value through both a marketing perspective as well as through employee relationships. Customers feel better about spending money with firms that have a positive image, and employees feel better about working for companies with a positive image. One note about social responsibility, though, is that it should not be the primary goal of the firm. For instance, a firm that donated 100% of their profits to a specific charity would be treating their stockholders in an unethical manner. The firm's management is essentially allocating the stockholders' money to the extent that social responsibility adds value. It is a win-win situation as both society and the shareholder benefit. However, spending too much on social responsibility to the point that it lowers firm value is merely a situation of management taking money from shareholders. An agency relationship exists when one party, the principal, hires another party, the agent, to perform a task and then grants that agent decision-making authority. In the context of finance, the primary agency relationship exists between managers and stockholders. Stockholders are the principals and management is the agent. If both the principal and the agent have the same goal, the agency relationship is strong. If not, there is potential for an agency conflict. The corporate form of business organization introduces an agency conflict as stockholders want managers to maximize firm value, and managers want to maximize their own happiness. Oftentimes, these goals do not align. In order to align these goals, a compensation system needs to be designed that compensates management for engaging in value maximizing behavior. One tool for this is to make a significant portion of management compensation in the form of company stock. This makes managers into stockholders and helps align their goals. Executive pay is a controversial issue as the level of executive pay has exploded over the past decades. In 2016, the average total compensation for CEOs of the S&P 500 firms was $13.1 million. This is 347 times the average compensation of production non-supervisory workers. Notice that the comparison is not to all other employees, but to a specific subset. Alphabet's CEO topped the list with total compensation of $100.6 million. A recent study by MSCI found that on a 10-year cumulative basis, total shareholder returns of those companies whose total summary pay, the level that must be disclosed in summary totals tables of the proxy statements, was below their sector median, outperformed those companies where pay exceeded the sector median by as much as 39%. In other words, The greater the compensation of CEO, the lower the performance. Some people will argue that the high level of executive compensation is merely a reflection of market forces. The job of CEO is demanding and consuming. A top quality hire may be able to make significant gains for shareholders, and the number of qualified candidates is relatively small. No one is forcing firms to pay these high levels of compensation. If there are a billion shares of stock outstanding, example, Walmart has approximately 3 billion shares as an example, and the CEO can make the value of each share increase by 50 cents a share, more than the next most qualified person, he or she would be worth 500 million more to the shareholders. For large firms, the value of the CEO can easily be in the hundreds of millions or more. Thus, maybe the large compensation packages are justified. On the other hand, are executive salaries really operating on a free market? Do the boards of directors that are responsible for setting salaries and hiring executives really have the shareholders' best interests at heart? For instance, let's say you were on the board of directors for XYZ Corp. Might you be more willing to pay whatever it takes to get the person you want for the job or retain the person currently in the job? After all, you're not spending your money. Also, if you are currently an executive elsewhere or have the potential to be one in the future, isn't it in your best interest to push the market price of CEOs higher? Do you think it will be easier to work with the CEO, who is often interacting with and usually a member of the board, when the CEO is well compensated? There are several arguments that call into question whether or not the board of directors is ideally suited to determine optimal CEO salaries. There are arguments that suggest CEO salaries are justifiably high and those that suggest that they are artificially high. You can make a rational argument for each side of the debate. You should consider the arguments instead of making your decision solely based on emotion.